toolbar located on the right side of your screen. Also at the bottom of the toolbar, you'll see a chat box. Feel free to send us your questions during the presentation, and as I said before, we'll do our best to address them. There are going to be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. If you have a chance, please take a moment to complete it, and this is our way of being able to provide you with the best and most relevant programs possible. So with that, I'm going to turn it over to Tony. Thank you so much, everyone. Thanks, Tony.
Thanks, Brooke. Hey, thanks, everybody. Tony Nitti coming to you from the most professional environment I can imagine, my kids' playroom. I'm doing that for 2 reasons. Number one, I'm home today because we're all leaving to come back to New Jersey for the holidays here in a couple of hours. And then 2, I had to lock myself in the playroom because our 11-year-old yellow lab has been kind of injured and laid up for the last week. And she's super sensitive to any kind of sounds or anything. She's just kind of anxious. So anybody, comes by the door, knocks or whatever, she's gonna start barking like crazy. So my guess is we'll hear Macy at some point during the presentation. But let's jump right in, because somehow I've been tasked with boiling down 1,097 pages of proposed text and summary reports into an hour presentation. But I'm confident that we can do it. Okay. So every time we talk, right, I give kind of these brief caveat. I'm just going to make it super brief this time. We know how we got here, right? This is a Republican-led tax plan. It was passed without a single vote from a Democrat. And so the Republicans own this plan. If I criticize it, and I might criticize aspects of it, that does not mean I'm a bleeding heart liberal and half of you should hate me. If I praise it, and I will definitely praise aspects of it as well, that does not mean I'm a diehard conservative and the other half of you should hate me. Okay, it's tough to talk about policy without sounding like we're talking about politics. So I just want you to understand that my ultimate allegiance is not to the right or the left, it is to the math, okay? And there shouldn't be much commentary today because we're really just sticking to what does the plan say, all right? But again, I have to give that caveat. And my first point of praise here about where we stand today, and in case you don't know, right, this isn't speculation anymore. This isn't will they or won't they. This is our new law. What we're about to discuss for the next hour is your first look at the way the tax landscape is going to be starting January 1st, 2018, okay? And much is being made in social media circles and on the web about this plan and who wins and who loses, and it's really tricky to say. But I will say this, right? The plan has always been sold as a middle-class tax cut, and President Trump and Steven Mnuchin have come out and said, the richest 1% will have no net benefit. Do we get to those targets? Well, certainly the richest 1% are going to have a big windfall. I mean, that just goes without saying when you look at the nuances of the bill. But I think many steps have been made throughout the process to make this more of a middle-class tax cut. And trust me, I've been very critical of the process, and I think you can see why when you look here at this slide, how things started. Back on November 2nd, when the House issued their bill, hard to call this a middle-class tax cut back then. It was an $850 billion corporate tax cut, another $450 billion going to owners of S-corps and partnerships. But keep in mind, the way the House bill used their benefit for flow-through entities, it really inured mostly to the richest 2% because they were going to go with a 25% flat rate. We've got the deemed repatriation on the international side, but the House bill had a big giveaway on the estate tax side, which naturally goes to the richest 1%. All that was left under the initial House bill was $224 billion over 10 years in tax cuts for individuals, right? And that's all individuals, right? Not just the middle class. So you can see in the Senate bill that some improvements were made. The corporate cuts went down. The estate tax cut went down. More ends up in the hands of the middle class. And then in the final bill, the corporate cuts gone down even more. And now the individual cuts have jumped from $224 billion under the House bill to $630 billion under the final bill. Now, how much of that $630 billion goes to the middle class versus the richest 1%? Time will tell. The initial scores aren't bad, right? It has the middle class enjoying about a 2% increase in after-tax income. The richest 1% is closer to 3%, but the middle class, in most scenarios, shouldn't have much to complain about with this new tax bill. Unfortunately, the part of the country I'm speaking to today, New York, New Jersey, high income tax states, if you've got, I'm sure I'm talking to many people in that state, in those states right now, who, make a very good living in a high income tax state, maybe with multiple children. There's always going to be anomalies in tax reform. And about 8 to 12% of people are going to have an increase in their tax bill in 2018 relative to 2017. There are many places I teach across the country where I can comfortably say, you're probably going to be insulated from those increases. Unfortunately, speaking to people in New York, New Jersey, you probably have a much better chance of being in that 8 to 10% that has a tax increase than other people do, okay? Just because of the nature of the changes. So let's jump into the changes because there is a lot to consider here, and we do only have an hour together. First things first, I need you to kind of tune in here and understand that every single individual tax change that we're going to talk about today, save for the change to the individual mandate and the alimony deduction, every single one of them on December 31st, 2025 is going to miraculously, like Cinderella's carriage turning back into a pumpkin, it's all going to expire. Every individual cut we're talking about will expire at the end of 2025. Why? Well, we're not going to get into the process of how we got here this time. We've talked about it in the past, but the Republicans used the budget reconciliation process to pass this without a single vote from a Democrat. But to do that, they needed to fit this bill within some budgetary constraints. The total cuts couldn't exceed 1.5 trillion over 10 years, which is why you see on this slide all the versions butt up right up against that $1.5 trillion number. And then the bill couldn't add to the deficit beyond the 10-year budget window. Initially, this bill would have violated that final rule. It would have added to deficits beyond 10 years. So what's an easy way to overcome that violation? Simply make every individual cut expire at the end of 8 years instead of 10 years, okay? And so now, just by doing that, this bill will not be adding to the deficit beyond the 10-year window. That's why they were able to pass it. So it means that when you hear a lot of rhetoric out there that, hey, there's nothing left for the middle class after 10 years under this bill, well, there's nothing left for anybody by definition if all the individual cuts are going to expire. Now, the corporate cuts are permanent, and that's a look of bad optics. Why are the corporate cuts permanent and the individual cuts temporary? But it's actually a stroke of genius because the Republicans are basically protecting themselves if things switch in 2024 and Democrats control all 3 houses. If the corporate cuts were temporary, it would be easy for a Democratic-controlled Congress to simply let those cuts expire. But by making the corporate cuts permanent and the individual cuts temporary, even a Democratic-controlled Congress is going to have a tough sell letting individual cuts expire. So the fact that these individual cuts expire is really just a budget gimmick. And it's everybody's expectation that these cuts will be extended. Now, that doesn't mean it's going to happen. That's just the expectation. So if you do see articles out there showing that there's nothing left for the middle class after 2025, please understand why that is, right? Because the way the bill was written to comply with the budget restrictions, every cut's supposed to expire at the end of 2025, but that's exceedingly unlikely. Okay, so tax rates. What's your rate going to be? Everybody wants to know. This graph or table is a little misleading because it makes it look like there's many, many brackets. There's 7 brackets under current law. There's 7 brackets under the new law. It's just that those brackets kick in at different income levels, which is why I had to, kind of make this. If I wanted to have it all in one place, I had to kind of make it look like there's more going on here than there really is. So the new rates, right? 7 bracket system, just like under current law, but the rates more or less come down at every step along the way, okay? And so you can see marginal decreases. Perhaps the biggest change along the way is just that where are we here? So the biggest change along the way is that the top rate has come down to 37.5%. Okay, and so that rate was going to be 39.6 under the Republican plan. It was going to be 37% under the original Senate bill. So now a top rate of 37% is certainly a welcome change for people who make more than the top threshold. The other welcome change is that the top threshold will be increased as well. As you can see here, right, under current law, you pay tax at the top rate once you make more than $420,000. Sorry, I'm having trouble with the slides. Let me go back here. All right, I'm not going to try to draw because that's just making life very difficult on me. All right, there we go, back. So under current law, you pay the top rate if you're making more than $420,000 or so if you're single. And now, as a single taxpayer, you'll only pay the top rate of 37% if you make more than $500,000. You can see along the way the rates are being reduced lower down as well. If you are married, the top rate had been kicking in at 39.6 at $480,000 of income. Now it's not going to kick in until $600,000. So you'll get another $120,000 of income taxed at 35% instead of 39.6. So that's nice. That's a 5% reduction on $120,000 of income. So that's a pretty significant saving right there. And then everything above $600,000, if you're married, is going to be taxed at that 37% rate. So you can see that the final version of the bill actually put the marriage penalty back in. Previous versions of the bill, you were going to pay tax at the highest rate if you made more than $500,000 single, $1 million married. Now it's $500,000 single, only $600,000 married. So that marriage penalty is in fact going to kick in and hurt married couples relative to single taxpayers. All right. But by and large, the Republicans did a pretty good job. Marginal rates go down pretty much along the way, particularly if you're married. And so just from a pure rate perspective, everybody should have a lower rate than they did under current law. Capital gains and dividends. I know a lot of people are interested in this, but despite all the movement in this new tax bill, despite the fact that this is the most significant overhaul of the law in 31 years, cap gains and dividends have just been left alone. So if you were paying 0% in 17, 15% or 20%, you're going to be paying the exact same rate next year at the same exact income breaks, right? So nothing changes here. Most people pay 15%. If you make more than 425 or so single, you'll pay 20. You make more than 480, you'll pay 20 if you're married, but nothing changes here. So you don't have to panic about any radical year-end planning of selling off assets or deferring asset sales because your cap gain rates is going to be significantly different, okay? The individual mandate for insurance, it is going to be disappearing in 2019, so there will no longer be a penalty. This was actually a revenue raiser for the IRS because even though, fewer people are paying a penalty to the IRS, from a government perspective, they have to pay less in the way of Medicaid, and they're going to be giving out fewer premium tax credits because about 13 million people are predicted to roll off of insurance if there's no penalty keeping them on. And so this raised $330 billion that allowed the Republicans to cut taxes elsewhere. Now, the impact on those left behind in the insurance rolls is going to be pretty fascinating to see. If a lot of young, healthy people drop off the insurance rolls, who knows what's going to happen to premiums for everybody that sticks behind. Time will tell. Now, this change, the individual mandate, will not expire at the end of 2025. This is a permanent change. So let's go ahead and hit our first polling question.
Okay, great. And just a reminder to everyone that polling questions are necessary if you're looking for CPE credit. You have to make sure you answer them. So here we go. Number one, it will be up for a minute. The top rate on individual ordinary income is 1, 32%, 2, 40%, 3, 39.6%, or 4, 37%. So it's going to launch right now. So make sure to get those votes in. You'll have about 1 minute. About 30 seconds left, everyone. And I see some of you arriving just now, so make sure you answer our polling questions if you are looking to get CPE credit for this webinar. Okay, and we're going to be wrapping it up right now. And those are the results. Tony, how'd they do?
Why can't I see my results? I don't get to see them.
Oh, no. Okay. Guess I can just see them. So it looks like most people went with D.
What was the answer for D?
37%.
Good job, everybody. Let's keep moving. We got lots to cover here. On the low income side of things, we're going to get a lot of simplicity in the law because the standard deduction is going to be doubled to $12,000 if you're single, $24,000 if you are married. Okay. And so it creates a larger 0% tax bracket because, again, everybody gets to deduct the greater of their standard deduction or itemized deduction. So if standards are going to be doubled, then it should create a larger 0% bracket. However, in conjunction with the standard being doubled, personal exemptions are going to be eliminated. And so barring some kind of softening of the blow, taxpayers with large families would actually suffer under this bill because you lose your personal exemptions. There's going to be a tipping point where even the doubled standard deduction doesn't help you. On the next slide, we're going to see what they did to protect families. And we're going to see that in most cases, we're going to end up just fine or else even better off by losing our personal exemptions. But of course, there's always anomalies, people with kids in college, things like that, or who make too much income, they're going to get whipsawed. They'll lose their personal exemptions and they will not benefit from kind of these new provisions that are going to soften the blow. But I want to focus on standard deductions for a minute because it's important. If standard deductions are going to be doubled, and as we're going to see in a little bit, most itemized deductions are going to be ripped from the pages of the law, and those that remain behind are going to be severely limited. This creates a scenario where in 2018, it's anticipated that 94% of taxpayers will be claiming the standard deduction. If that sounds like it may be you, then you've got 2 weeks left to understand that some of these deductions aren't going to do you a lick of good if you incur them in 2018, right? You got to move them into 2017 if you can. And so if you're going to be taking the higher standard deduction, or even if you're going to be itemizing, you've got to recognize what deductions are going to be left behind. We always want to accelerate deductions for the time value of money, but this year it's different, right? Deductions we don't take this year might be gone forever. Case in point, right? If you are getting a master's degree and your employer is paying for it, or not paying for it, I'm sorry, and you're deducting the tuition as an unreimbursed employee expense, well, guess what? All unreimbursed employee expenses are going to disappear in 2018. So pay that tuition for next year now if you can, right? Medical expenses, right? Maybe you're not going to be taking itemized deductions next year. So get that surgery in the next 2 weeks instead of in January. And then we'll talk about state and local income taxes, and we really hope to be able to prepay 2018 state taxes, but unfortunately the final legislation removed that possibility. But we'll talk about that when we get to itemized deductions. But what I want you to understand is if you're going to be among that, group of people who isn't going to be claiming itemized deductions next year, then, for example, why write a gift out to charity on January 1st if you can do it on December 31st, right? I know there's other reasons for charitable giving, but you just got to understand that you may not get a benefit from that charitable contribution next year, and you may get that benefit this year. So when in doubt, accelerate into the current year, okay? All right, so if you've got kiddos and right now you're worried about, if you're worried about how you're going to be made whole for losing personal exemptions, what they've done is they've doubled the child tax credit from $1,000 to $2,000. They've also given us a $500 credit for any non-child dependents that we have, like an elderly parent, for example. Now, if you're familiar with the child tax credit, you know that it didn't do anybody much good in the past because you couldn't take the credit once your income exceeded $75,000 if you're single, $110,000 if you're married. Well, they've raised those thresholds now to protect the middle class who are going to be losing personal exemptions, where you're going to be able to get the child tax credit in full until you get to $200,000 of income if you're single, $400,000 if you're married. So that's going to protect a lot of people. But remember, the child tax credit is only for children under the age of 17. So you're not going to get it necessarily for all your children. And then also understand, if your income gets above those thresholds, you start losing that credit. And so there will be people who get whipsawed. There will be people, making more than $400,000 who, there will be people who lose not only their personal exemptions, but can't take the child tax credit. Now, if you're on the low income side of things, they've increased the refundability of the child tax credit from $1,100 up to $1,400. That was a last minute change. That's going to help taxpayers who have no liability get an increased $300 refund. But by and large, this has come a long way from the original versions. It's going to help large families much more than the previous iterations would have, okay? All right, strap in, because here's where it gets interesting. We could spend the next 2 hours talking about nothing but this, and we still wouldn't fully understand it. But what is changing? The way we tax the income earned by sole proprietors, shareholders of S Corps, and partners in partnerships. Why is it changing? Because the corporate rate is coming down to 21%. And S Corp owners and partners in partnerships and sole proprietors, you all pay tax on the business income at the individual level at the mercy of your individual rates. And we just learned that the top individual rate is going to be 37%. So if you're going to be paying 37% versus corporations paying 21%, even with double taxation on C corporations, C corps are going to look mighty attractive. And so they want owners of S corps and partnerships to retain their competitive advantage over C corps. And there was a lot of different ways they were talking about doing it. And the different ways created different winners and losers. But this is what we settled on. And once again, there are winners and there are losers. And one of the winners came in at the last minute, and that's people who own a lot of real estate. So the way it's going to work is this, in a nutshell, okay? Your ordinary type income from your S corp, your partnership, or your sole proprietorship. So what we call, your business income, not your capital gains or your dividends or things like that. You are going to be entitled to take a deduction of 20% of that income. And so just, quick numbers, if you make $1 million out of an S corp, you'd be entitled to a 20% deduction, so you'd only pay tax on $800,000. The effect of that, if the top rate is 37% and you're getting a 20% deduction, the effect of that change is to really drop your top rate on flow-through income from 37% to 29.6. Now, there were certain taxpayers under the House bill who would have gotten a 25% rate, so it's not quite as good as it could have been, but it's still a pretty nice advantage relative to double taxation in C corps. The trick, though, is who gets the 20% deduction. And first, there's just a general limitation. And what they're trying to do here, and I'd love to explain it in full, but we just can't in the interest of time. They're trying to prevent situations where you own a business and you say, hey, why take wages out? Or why pay anybody wages that are taxed at ordinary income if instead we can let the income flow through to us and get a 20% deduction? And so to prevent those abuses, what's going to happen here is your 20% deduction is going to be limited to 50% of the W-2 wages that are paid out by the business. Not just to you, but all W-2 wages. So if you're, an owner of an S corp, yeah, you get your 20% deduction, but limited to 50% of the total wages paid out by the S corp. And so on the surface, before we dig any deeper, if the S corp doesn't pay any wages because it's trying to avoid paying you wages that are taxed at ordinary rates, then you're going to end up with no deduction. So that's how it was going to work originally, and that was going to really hurt owners of real estate because rental properties have a lot of income, but they don't tend to pay W-2s. And so I actually wrote an article for Forbes a couple of weeks ago saying that, you know, who had the most at stake here in between the House and Senate bills were landlords, because under the House bill, they would have gotten a flat 25% rate. Under the Senate bill, they would have been paying tax at 39.6 in most cases. And so what the final bill did is it added in at the last minute that your limitation on your deduction is not just 50% of wages, it's the greater of 50% of wages or 25% of wages plus your share of 2.5% of the adjusted basis of property used in the business. And I should have also mentioned that 50% of wages, it's 50% of your share of the wages. So if you're a 100% owner, it's 50%. But if you're a 50% owner, you take 50% of the wages and then multiply that by 50%. But this second limitation is going to really help owners of real property because you may not have any wages, but you're going to be able to take your deduction up to 2.5% of the original purchase price of, for example, your rental building. That was a last-second bailout. It's created quite a bit of controversy, but it's really going to help people that own rental real estate. Now, here come the caveats. These limitations that we're talking about for wages and share of property, they don't apply if you have less than $157,500 of income if you're single, $315,000 if you're married. A lot of people are confused. Those thresholds, are they AGI? Are they flow-through income? They are actually taxable income numbers. And so if your taxable income is over those numbers, even though your flow-through income might be much less than those numbers, you're going to start to lose those deductions, that 20% deduction. And the deduction goes away fast. By the time you're making $207,500 if you're single, $415,000 if you're married, it's completely gone, okay? So this limitation on wages, I shouldn't say the deduction is completely gone. The ability to ignore the W-2 limits will be gone by the time you make $415,000 married, $207,000 if you are single, okay? Now, this deduction generally is not available to anyone who applies their trade the way I do, as an accountant or a lawyer or a doctor. Anybody who under Section 1202, whose principal asset of their business is the expertise of the owners or employees. Now, at the last second, they pulled out architects and engineers from this description. So it's a big win for architects and engineers. But generally, accountants, lawyers, doctors, you don't get the 20% deduction unless you earn less, your taxable income is less than $157,500 if you're single, $315,000 if you're married. And same thing as before. By the time you're making $415,000 married, $207,500 if you're single, your deduction completely disappears if you are a doctor, lawyer, accountant, whatever it may be, okay? So the bad news is you won't be filing your tax return on a postcard. There's a lot of complexity here, especially when you get into the phase-out range. I want to work through just a couple of basic case studies that don't get into the phase-out range, because trust me, you don't need to see that math at this point in your life. It's pretty complicated, okay? But just I want you to show you how this bill is supposed to work. A and B are married, taxable income of $700,000. A is a 50% owner of an S corp. His share of the S corp's income is $500,000. That's line 1K1. His share of the W-2 wages is $220,000. And his share of the basis of the assets in the S corp is $600,000. The S corp is not a personal service business. All right. Here it's pretty simple. We start out by saying, okay, taxable income is $700,000. That's over, the $315,000 threshold. And so we know the W-2 limitations are going to apply. In fact, we know they're going to apply in full because we are above $415,000 taxable income, which is the upper end of the income phase out. So we got to dance through these limitations. So we start by just saying, what's 20% of our qualified business income? And that is your share of the income of the business. And remember, our share of the income was $500,000. Importantly, your share of the business income eligible for this 20% deduction does not include any wages you pay yourself. So you don't get to take a deduction against your wages or guaranteed payments if you're a partnership. But we start off with a $100,000 deduction. Now we've got to figure out our limiter. And we've got two potential limits, and we get the greater of. Number one is 50% of your share of the W-2 wages. Well, W-2 wages was 220 grand, so 50% is a $110,000 limit. Then we have an alternative limit, 25% of W-2 wages plus 2.5% of the $600,000 basis. That's your share of the assets. That comes to 70 grand. So you get to take your deduction equal to the greater of 110 or 70, but limited obviously to the actual deduction. So our deduction was 100,000, 20% of 500 grand. Our upward limiter is 110,000. So in this case, we're entitled to the full $100,000 deduction. If 50% of wages in this case had been $30,000, then your deduction would be limited to $30,000 because you're over those thresholds, okay? All right, so now, assume A and B are married, taxable income is only $200,000. A is a 50% owner of an S Corp. A's share of the S Corp income is $100,000, share of wages is $10,000, share of basis is $40,000. Once again, not a personal service business. Well here, right, we start off by taking 20% of our QBI of 100,000 for a tentative deduction of 20,000 bucks. We don't have to sweat the W-2 limitations because we are earning less than $315,000 in taxable income as a married couple. And so we can just flat out ignore this computation. And it's a good thing we can ignore it because W-2 wages were only $10,000. So half of that would have been 5,000 bucks. And then our second limitation is even less. So barring an exclusion, we would have been limited to a $5,000 deduction. But because we make less than $315,000, we get to completely ignore this computation here and just take our $20,000 deduction. As you start making more than $315,000, you're going to lose that kind of get out of jail free card they give you where they let you ignore the wage limit. You're going to lose it, and you're going to lose it fast, okay? Now, what happens if we go back to our original fact pattern? A and B are married, taxable income $700,000. A is the owner of an S Corp with $500,000 share of income, $220,000 share of wages, $600,000 share of business assets. Only now, the S Corporation is a personal service business, accounting, doctor, lawyer, whatever it may be, right? Here, it's simple. We're over $315,000 of income, taxable income. In fact, we're over $415,000 of taxable income. So we get nothing. We get no deduction, okay? Now, if instead we're in a personal service business and our taxable income is $200,000 and our share of income is 100 grand, share of wages is 10,000 and share of assets is 40,000, well, now, normally, we wouldn't be entitled to a deduction since we're in a personal service business, but because we make less than $315,000, not only do we get to take it, we get to ignore the W-2 limits as well. So we get to take $100,000 of income, multiply it by 20%, and take a $20,000 deduction against it, even though we are a personal service business and even though we have a W-2 limit that normally would apply, okay? And so the math gets tricky as you get above 315 because these benefits are going to be phased out from 315 to 415, and it's not that bad for someone, you know, that spends their whole day in Excel. But if we walk through it right now, you know, heads would be spinning. But just understand that if you're an accountant or a doctor or a lawyer, the minute your taxable income exceeds 315, you're going to start to lose the benefit fast of the deduction. And what that ends up meaning is your effective tax rate on each dollar of income you earn as a married couple between $315,000 and $415,000 of income is going to be upwards to 80%. You're going to be paying almost 80 cents on every dollar you earn for that swath of income because you're paying a 35% regular rate. You're paying another, 22% on losing this particular deduction. and then you're paying another, 15, 20% on the child tax credit phase out above $400,000. So these laws, the way they interact, create some very, very strange results. Now, some people have said there's a huge planning opportunity here. I'll let you decide, right? The numbers may work, they may not. It depends on a number of factors. But think about this. You've got a law firm that has 3 partners and 6 associates. The 6 associates are all married. They've all got taxable income of less than $315,000, but we're going to call it exactly $315 for our purposes here. And they all get a wage of $300,000 from the law firm. Well, wages are going to be taxed at the wages are going to be taxed at ordinary rates as high as 37%. And now what happens here is what we could do is say, all right, if we just stick with the plan and pay out wages, under the new bill, the income tax on $300,000 of wages plus another $15,000 of other income is going to be $64,000. And the payroll taxes, the employee share, is going to be another $12,600, so about $76,000. What if instead we tell these 6 associates, go out and form your own partnership and engage the law firm to provide services? And then the law firm will pay your LLC $1.8 million instead of paying you $1.8 million in total wages. And then you can allow that $300,000 to be passed out to each of the individual associates. So now, right, even though this LLC doesn't pay any wages, and even though these associates are lawyers, because their income is less than $315,000, they could take a 20% deduction against their $300,000 of QBI. That's a $60,000 deduction. That's going to reduce their taxable income to $255,000. That's going to reduce their tax liability from an income perspective by almost $14,000. But don't forget, now the associates will give up potentially tax-free health insurance. They'll have to pay self-employment tax. And so they'll have to pay the employer and employee share, but they will get a 1/2 deduction for the self-employment tax. And so does the math work? Does it make sense? I think it depends. Will the law firm gross the lawyers up for their lost health insurance and for their increased payroll tax? But in some situations, it might make sense. There may be, a couple $1,000s of annual savings to the former employees. So something that we're going to have to keep an eye on from a structuring perspective. Then, if you own property, you are very happy about this last minute change, okay? Because let's say you make $2 million and $1 million of it is from rental income. And your rental property, as many rental properties doesn't pay out any W-2 wages. Instead, it pays a management fee to a management company. Your share of the purchase price of that commercial building, though, is $9 million. Well, on the surface, you'd be entitled to a 20% deduction of $1 million. That's $200,000. The problem is, until last Friday, that deduction would have been limited to 50% of W-2 wages, and there are none. And so you would have gotten no deduction at all. But at the last minute, they added in this second tier where you can take your $200,000 deduction up to 25% of W-2 wages, which is 0, plus 2.5% of your share of the basis of the property of $9 million. That's $225,000. And so just like that, you get a $200,000 deduction, whereas 5 days ago, you would have gotten 0 deduction. So this last minute change is a huge, huge win for people who own real estate. Okay. All right. Polling question number 2.
Okay. Going to launch it right now. Just as a reminder, everyone, we do need you to answer these in order to get CPE credit. So number 2, subject to limitations, sole proprietors, shareholders in an S corporation and partners in a partnership are entitled to a deduction or of what percentage of their qualified business income? 30%, 23%, 20%, or 17.4%? You have about 25 seconds left to answer. And I know a lot of you are sending some great questions in. If Tony doesn't get to it, I will send those over to him, and we'll get you an answer after the webinar.
Yeah, I'm happy to answer all the questions, and I know there's a lot of them. Trust me, trust me, trust me. And maybe I'll answer some of them here as we keep going through. Am I ready to go, Brooke?
Not yet. We still have a little more time. Okay, now we are done. And those are the answers. Tony, everyone went, most of the people went with C. Were they correct?
I don't remember. I can't see the questions, unfortunately.
Oh, okay.
I'm sure they're correct. These are smart people. Yep, they got it. They're good.
Okay, awesome. All right, back to you, Tony.
Okay, perfect. Let's keep moving then. Itemized deductions. You've probably heard big changes coming, right? You might have heard medical expenses were going to go away, medical expense deductions. No, they're back in the law, and they're actually a little bit better. The 10% floor is going to be 7.5% for 2017 and 18. Then it'll revert back to 10%. So that's good news. Not so much good news on the property tax and state and local tax deduction front. You're going to be limited to a $10,000 deduction when you combine, property taxes and state and local income taxes. And so the only change they made is to say, it used to be just 10,000 in property taxes. Now, if by some miracle in New Jersey, your property taxes are less than 10 grand, you can fill in the gap. With your state and local income tax deduction, okay? But that's really not going to help. That was really engineered more for California, where real estate taxes are low, but income taxes are high. And so you got a maximum $10,000 deduction. So we would have loved to be able to tell you all to go out and prepay, all your 2018 state income tax liability. But unfortunately, the final bill says any payment made in 17 towards a 2018 state tax liability will be treated as if it was paid in 2018. So they killed our ability to prepay state and local income taxes. That said, if you can prepay fourth quarter of 17 state payment without being an AMT, you absolutely should. If you can get your county to accept the prepayment of next year's real estate taxes, I would encourage you to do it. There's some dispute over whether or not we can. I am comfortable with it. I know I don't speak for all Withum, Smith & Brown, but it's something you can reach out to us and talk about. But prepayment is the name of the game where you can do it. But you can't prepay out, years worth of deductions, because then you're creating an asset that extends beyond 1 year. Mortgage interest, okay? Any new loans taken out after December 15th, you're going to be limited to the interest on $750,000 of acquisition debt and no interest on home equity debt, okay? And so just something for you to be aware of. There's going to be now current debt, you still get the interest on $1 million. You refinance that debt, you still get it on $1 million. Other miscellaneous itemized deductions, things like tax prep fees, unreimbursed employee expenses, investment advisory fees, they are all gone, okay? Some other changes you might have heard about, I want you to know, didn't make the final bill. You still only have to live in your house 2 out of 5 years as your principal residence to get tax-free gain on the sale. They were going to raise that to 5 out of 8 years. You can still deduct your student loan payments. They were going to get rid of that. Employers can pay up to $5,250 each year on behalf of an employee to go back to school, and it's tax-free to the employee. That will remain tax-free. Tuition waivers for doctorate candidates and dependents of college employees, those tuition waivers will remain tax-free. A lot of things were, slated to disappear and ended up not disappearing. So I just want to point those out whenever I can. All right. Charitable contributions are not up here because they pretty much come out of this unscathed. Page 1 deductions, your alimony payments. Under current law, alimony payments are deductible by whoever pays them. They are includable in income by whoever receives them. And that's going to change for decrees entered into after 1/1/19. So they're now giving us a year to finalize these divorces. After 1/1/19, alimony will not be deductible and not be, not be includable in income by whoever receives them. Moving expenses, if you move for a new job, not going to be deductible on a go-forward basis. Teachers, that $250 deduction you get on page 1, that has been preserved. Charitable contributions, like I said, come out of this pretty much unscathed. However, there's a 60% limitation of AGI now instead of only 50%, so that's good news. The bad news is someone reached out to me yesterday and asked this question. Hey, if I pay Rutgers University for the right to purchase season,
Oh, Tony, we actually can't hear you. You may have gone silent. Hang tight, everyone. If you can hear Tony, please raise your hand.
And that's going to revert back to current law at the end of 2025. So there was talk that the bill was going to, someone
Nope, we can hear you again.
Oh.
We can hear you again. You're back.
How long did you lose me?
You know what? I think I was actually getting a voicemail, so I think I was the only one who lost you. So continue on.
Yeah, somebody would have said something. Okay, so there was talk about the estate tax being completely repealed. It's not going to be, and so the exemption in 2025 will be $22 million if you're married. 2026, it'll revert back to being $11 million if you're married if nothing is done. And so, just preparing you now as your advisors, we may have some advice for you in 2025 where it's time to head towards the light, because you're going to want to pass on in 2025 and not 2026 if the estate tax exemption is going to revert back. I'm joking, of course, but you get the idea. AMT, believe it or not, it's still in the law. And so that's why anytime a politician tells you, Republican or Democrat, that we need simplicity in our tax law, you can just simply ignore them. We're still going to have to deal with the AMT, but the reality is the exemption amount is much higher. Plus, with no state and local income taxes, no personal exemptions, no other miscellaneous deductions, it's not all that likely to apply. Okay? Corporate rate immediately drops all the way to 21% for both regular corporations and personal service corporations. So that is going to be a huge bounty. Remember, the total tax cuts in this bill is $1.5 trillion over 10 years. The corporate cuts alone are going to be $1.4 trillion in cuts. So there is a lot to pay for these cuts. Corporate AMT was completely eliminated. For those of you out there who rely on the R&D credit, you are greatly relieved, because when the Senate passed its bill, it inadvertently killed off the R&D credit and made a $290 billion mistake, because it reinstated the corporate AMT at a 20% rate. But the regular AMT is a 20% rate. And so if corporate tax and AMT were the same, no one would get the R&D credit unless you were a small business. So polling question number 3.
Okay, it is about to launch. Everyone, make sure you get those polling question answers in. Okay, the following itemized deductions have been eliminated: tax prep fees, unreimbursed employee expenses, casualty losses, or all of the above. And we're giving you guys that full minute. You have about 45 seconds left. About 10 seconds left, everyone. Okay, and we're closing it out now. Tony, I believe everyone's going with all of the above. Were all those itemized deductions eliminated?
You got it. And I didn't even tell you about casualty losses. So.
Good job, everyone. Okay, back
to you. Yeah, casualty losses, you're only going to be able to take casualty losses on a go-forward basis if you are part of a federally declared disaster area. So, yeah, unfortunately, that's the way that's going to go. And it won't be an itemized deduction. All right, 100% expensing is here. And so for assets purchased after September 27, 2017, with a life of 20 years or shorter, you can write off the full cost, okay? And so your machinery, your equipment, and for most businesses, even your kind of qualified leasehold improvements, so to speak, will get the availability of 100% expensing, okay? And then starting a few years from now, that 100% deduction is going to be phased out. So a quick change, right? We have these notions of qualified leasehold, restaurant, and retail improvement property under current law. They are being replaced by qualified improvement property. The biggest difference here is qualified improvement property doesn't have to be pursuant to a lease, and it can be any improvement made after the building's placed in service, but it's specifically for non-residential property. So if you make an improvement to commercial property to the interior portion of the building that's not a structural component, you're going to get the advantage of a 15-year life as well as potential 100% expensing. I told you you'd hear from my dog at some point today. There she goes. So that's going to be a nice rule. Now, certain real estate businesses are not going to be able to take the 100% expensing on their qualified improvement property. I'll talk to you about that when we get to the interest rules. So here we go. Section 179 as a backstop, because we have 100% expensing, so who really needs it? But Section 179 is increased to $1 million instead of 500. Also note that the 100% expensing is for new and used property, as long as it's new to you. Okay, so that's different from the old bonus rules. Old bonus rules, it had to be brand new property, not anymore. Some other big changes coming down here for businesses, and I'm really excited about for some clients, because it can really simplify things. Number one, if you're a C Corp or a partnership with a C Corp partner, you have been required to be on the accrual method once your average receipts exceeded $5 million, right? Now that threshold is going to be raised all the way to 25 million bucks. And so even if you're a C Corp or a partnership with a C Corp partner with 20 million of average receipts, if you want to switch to the cash method, we can do that for you automatically. Then all businesses that have inventory, regardless of their income level, are required to be on the accrual method, right? Minus one or two small exceptions. Well, now they're saying, even if you have inventory, go ahead and be on the cash method until your average receipts exceeds 25 million. Trust me, that's very significant, okay? And what's even better is I'm not gonna have to do Section 263A UNICAP calculations for you anymore, because it's a mess and I don't like it. But until your average receipts exceeds 25 million, you're not gonna have to go through the trouble of capitalizing a portion of your G&A costs into your inventory only to be deducted when they're sold. 263A will not apply to either producers or resellers until average receipts hits 25 million. If you're a construction client, and I know Withum has many of them, you love using the completed contract method for long-term contracts, but you can't do it once receipts hits $10 million average. You have to switch to percentage of completion. Now you're going to be able to do it until receipts hits 25 million average. So much greater availability of the completed contract method. These are huge changes, okay? But can't be all good news. We got some bad news coming too on the business side. Number one, net operating losses for businesses and individuals. Under current law, carrying back 2 years, carrying forward 20 years, starting with 2018 losses, they can't be carried back anymore. And even your current losses, you can carry them forward, and you can do it indefinitely now, but you can only offset 80% of your taxable income. So if you've got losses and now you're going to be taxable in the future, prepare to pay some income tax, okay? Section 199 manufacturing deductions going to disappear. Pure entertainment deductions disappear. You can't take even 50% now of like taking somebody golfing or skiing or whatever it may be. And then after polling question number 4, I'll get to our last big change.
Okay, here we go, getting ready to launch, everyone. The new corporate tax rate is 25%, 20%, 21%, or 30%. You guys have about 50 seconds.
And I'll do my best to get you out of here. Write it. I don't even know what time it is, to be honest.
It's 2:56.
It's on Mountain Time. You're on Eastern Time. Soon I'll be on Eastern Time. 2 days ago I was on Western Time. I can't keep it all straight.
We have 30 seconds left for you guys. Okay, we're going to be closing right now. Tony, was the answer 21%?
You got it. This is a smart group of people who should all be hired at Withum immediately. All right.
Great job.
Big change coming for businesses, and it's not a good change. If you make more than $25 million and you're not what we call a real property trader business, like construction, development, property management, a landlord, or unless you're a car dealership with floor plan interest, your interest expense is going to be limited. You're only going to be able to take your net interest expense, so interest expense greater than interest income, equal to 30% of your adjusted taxable income computed before depreciation or amortization. So it's going to be a pretty big hit for some businesses that are highly leveraged, right? You're going to be limited on your interest deduction, and carry forward deduction can be carried forward indefinitely. There's some complicated rules for interest expense limited through flow-through entities. The limitation applies both at the flow-through entity and then again at the individual level, but the individual can't count the income allocated to them from the flow-through entity, or else it would be double counted. So there's a number of rules we're going to have to get our arms around here for interest expense. But here's the thing. If you're in a real property trader business, right, landlord, management, whatever it may be, you can elect out of the interest rules, but the price you pay if you elect out is you have to, it looks like immediately switch over to depreciating your real estate on the ADS system, which is a longer lived straight line system. So your non-residential property would be depreciated over 40 years straight line, and your residential would be depreciated over 30 years straight line, if I have it correctly. I can't remember. And then you wouldn't be able to take 100% expensing on your leasehold improvements either. Those would be taken over an ADS life of 20 years. Okay, so that's the price you pay. Like-kind exchanges, we can keep doing real property like-kind exchanges. We can't do any personal property like-kind exchanges. You can finish the ones that are currently in progress. After 1/1/18, no more personal property exchanges. And then on the international side, we've talked about this in the past, we're going to move to a territorial system where if you earn money in a foreign affiliate and the foreign affiliate repatriates it back to the US in the form of a dividend, generally speaking, you're not going to pay tax on that dividend at all. You're going to get 100% dividends received deduction. However, there is the imposition of a kind of strange worldwide minimum tax hidden in the bill. I'll leave that to our international people to teach to you. And then there's going to be a deemed repatriation for all the income that's been stashed overseas that hasn't been subject to US tax yet, of 15.5% on cash, 8% on illiquid investments. If you've been paying attention along the way, you know those percentages have gotten ratcheted up. Why? Because there's a lot more tax cuts in the bill now than there was a month ago. And every time you cut taxes, you got to raise revenue because the total cuts can't exceed 1.5 trillion. And every time they needed to raise some revenue and they couldn't figure out where to raise it from, they just turned the dial on that repatriation rate, where now it's all the way up to 15.5%. Okay, but you're still not shedding tears if you had cash stashed overseas for the years, because you could have been paying tax on it at 35%. So it's not a bad deal. I'm looking forward to all the questions that come in. I will respond to all of them in a timely manner because you are Withum clients, so you go right to the head of the queue above all the complete strangers that have been emailing me questions for the last few days, so I can push those aside and address your concerns first. So send me your questions, or Brooke will send them on to me, and I will get them answered for you ASAP. All right. Thank you.
Thank you, everyone, for attending the webinar. Please send me any questions. I have some of your questions in the chat. If you have any other questions, like Tony said, you can send them to myself or to him or to any other Withum representative, and we will get back to you. Thank you, everyone. Have a great day.
Thank you.